Hi, I'm Jamsi. I'm a finance professor and welcome to another video. So for today, we're going to be talking about a subsegment in the financial market, specifically on mortgages. So this particular module revolves around the better understanding of how the markets for real properties impact the economy. So let's get right to it. So, first off, let's understand the concept of a mortgage. So, a mortgage is a loan to individuals or businesses to purchase a home, a land, or a real property. So, which means any property that we can hang on to, like a car, could be put up for a mortgage. That's why we have a car loan or a chattel mortgage for movable properties such as vehicles and heavy equipment. But more commonly, we look at a mortgage so that we can purchase a house, a land, or a building for, say, a business or an establishment. So, what happens when we apply for a mortgage? So when we apply for a mortgage, we often will approach a lending firm or a financial institution who has a loans department or that has a loans department. So this loans department will then assess our capacity to pay, our background, and will determine the amount that they can loan us for the purpose, given that we have submitted all the necessary documents such as proof of income, proof of address, and even the required collaterals in some cases. So we know the process of a loan starts with a loan application and ends when a loan is granted. And therefore, at that point, we start repaying the loan. But if we look at things from the lender's perspective, when we apply for a loan from a financial institution or from a lender, these loans that we are repaying currently sits in their balance sheet as a receivable. And because oftentimes these loans are long term, they are actually exposing themselves to maturity risk because usually a mortgage lasts for at least 5 years or more. So you can't really maximize or you can't really do anything about a 5-year receivable. So instead of waiting for these loans to be paid off, they have actually what do you call this? They have actually devised a way in order for them to be able to pass on the risk of those receivables to third parties. Now, how is that? That is through the process of mortgage securitization. Again, that's called mortgage securitization. So, mortgages are often securitized by the mortgager. So, who is the mortgager here? The mortgager is the lending company or the financial institution. We as individuals or our businesses are the mortgagees. So, when the mortgagor securitizes mortgages, they actually combine the mortgages into one large portfolio and then subdivide it into smaller pools based on the mortgage's inherent risk of default. So you lump it together and then later on, you divide it into smaller subgroups depending on how high the default risk of that mortgage is. Now, these smaller pools are then sold to investors in the form of bonds. So that way, they are actually selling that particular piece of bond to the investors. Now, if the investors actually buy into these types of securities from the financial institutions or the mortgagors, intentionally, they are taking off the risk of these mortgages out of the hands of these financial institutions or lending companies and essentially letting themselves take the place as the lender in exchange for a certain level of return that is equal to their risk tolerance. So by doing that, if the mortgage company through mortgage securitization is no longer the lender or the mortgagor, then what is their purpose here? They can actually act as collector in behalf of the new lenders. So this is the reason why these mortgage companies and financial institutions who are in the business of granting mortgages or loans are able to underwrite more loans, because as soon as they can develop a large portfolio of mortgages, they convert it to bonds, and the proceeds of these bonds that were bought from them by interested parties will be used to underwrite, sorry about that, a new set of loans. So by virtue, securitization allow these financial institutions to have more liquid assets and therefore reducing interest rate risk and credit risk. So later on, we will recap what interest rate and credit risk actually means. And by acting as collector in behalf of the new lenders, the financial institutions will have additional income streams from fees and charges that allow them to reduce the effects of regulatory constraints, rather, such as capital requirements, reserve requirements, and others. Because essentially, if you're in the business of mortgages, you would have to abide by the prescribed laws by the different governing bodies. So by securitization, you are freeing yourself from all that risk and removing the burden of having to comply with regulatory requirements. All right, so I hope that is clear. So in this next slide, we will be recapping what default, credit risk, and interest rate risk mean. Because in the previous slide, we have heard about the terms default risk, credit risk, and interest rate risk. So let's go through the definition of default risk first. So default risk is the risk that a lender takes on in the chance that a borrower will be unable to make the required payments on their debt obligation. So in the determinants of interest rates, this is one of the considerations of the lenders or the providers of funds before they can even charge an appropriate level of interest rate, because they want to assess the possibility that the borrower won't be able to make timely payments on their debt obligation. So that is default risk. On the other hand, we have credit risk. So credit risk is the possibility of a loss resulting from a borrower's failure to repay a loan or meet contractual obligation. So, if a particular borrower has defaulted on a loan, credit risk actually arises from the side of the lender because they have actually exposed themselves to a possible loss because of the defaulted loan by the borrower. So, third, interest rate risk. This is the potential for investment losses that result from a change in interest rates. So from our previous discussions, we know that interest rates are a component of many different factors, and oftentimes these components will change over time. And depending on the economic climate, interest rates can either increase or decrease. So since we are locking ourselves in from the viewpoint of the mortgage or the lending companies, they are locking themselves into a specific interest rate. If there is the slightest interest rate fluctuation, if the interest rate decreases and they have actually charged a higher rate, therefore, they might actually feel or they might expose themselves to additional losses. But if, on the other hand, interest rates move towards their favor, that's a gain on their end. Lastly, there is liquidity risk. And liquidity risk is also a subcomponent of the determinants of interest rate, and it refers to how an institution's inability to meet its obligation threatens the financial position or existence of the enterprise. So, because a business must have enough current assets to operate on a day-to-day basis, it is assumed that they are also able to meet their short-term obligations. If they are not liquid, they are having a hard time meeting their operational requirements and meeting their short-term obligations. If they are unable to meet the short-term obligations, therefore, they are also threatening the life or the existence of the business. That is liquidity risk. Throughout all of these things, we are reminded by the risks and returns trade-off. So, the risk and returns trade-off states that the potential return rises with an increase in risk. So, therefore, the higher the risk, the higher the return. So, this has been demonstrated by our lesson in the determinants of interest rates, where the greater the risk that a borrower is exposed to, the higher the required, or the greater the risk a lender rather is exposed to, the higher the required rate of return. All right? So, even with any other investments, if you are investing in higher risk securities, expect that there is a high payoff if it works well for you. If it doesn't, therefore, be prepared for catastrophic losses. So to end part 1, let's understand, why do we have to study mortgage markets separately? So what's the deal? First, mortgage markets are studied separately from other financial markets because of the following reasons. Number 1, a mortgage is specifically related to a real property. And the same applies to mortgage bonds. So let me break it down for you. So in a mortgage, an individual is specifically applying for a loan to purchase a specific piece of real property. In the event that the borrower is unable to meet the obligation towards the repayment of that specific piece of real property, the said property can be foreclosed and resold. So that is how mortgages work. So if you would notice, if an individual gets a car and sooner or later he is unable to meet the monthly obligations towards that car loan, it's highly likely that the bank will knock on his door and take away the car because they want to recoup the unpaid portion of the loan from reselling the car to a third party. So what's the difference with corporate bonds or stocks? So when corporate bonds or stocks are issued by these big firms, oftentimes they only give the holder of these bonds or stocks the general claim to their asset, and they cannot specifically identify which ones or which assets do these holders have the exact claim to. Unlike in the mortgage markets, the borrowers will have to answer for a specific property. Otherwise, that specific property can be taken away, and the proceeds of the resale could be used to settle the debt with the lenders. All right. Number 2, there is no set size or denomination for primary mortgages. So there is no ceiling or floor in the amount of mortgages that one can take out. Rather, the size of a mortgage depends on the borrower's needs and ability to repay. So bonds, on the other hand, will have a preset denomination at which you can purchase, and usually shares are sold at par value per share. So when you compare the mortgage market's instrument with your usual bonds and stocks, there is a minimum price tag for the bonds and the shares of stock versus these mortgages have none because you do not have a minimum nor a maximum amount of money that you can take out in mortgages. Third, primary mortgages only involve a single investor. So in a mortgage, you are usually looking at the borrower. You're usually talking to the borrower or the party who is responsible for paying the mortgage. Unlike when you are talking to bond holders or shareholders, because you have to talk to multiple people because they have many different investors. In the mortgage market, you only talk to one buyer, and the buyer only talks to one financial institution to close the deal. It's either he goes to a bank or a mortgage company to close a mortgage deal. Lastly, in the mortgage markets, the issuers are individuals. Now, when we say the issuers, meaning the people who transact in this specific segment of the financial markets, are individuals. So, unlike with other markets in the financial system, The mortgage market is predominantly transacted by individuals. So therefore, the information available on these issuers or these loan applicants are less extensive and unaudited. Unlike if you engage in money market transactions or if you go to the capital markets to purchase stocks, these information that these brokers and these institutions will require will have to be verified and authenticated for reliability. And the information that must be gathered must follow a set of rules and regulations. So what are we stating here? Engaging in the mortgage markets have less stringent requirements in terms of information because before you can even participate in the market. All right. So that ends part 1 of our lesson in the mortgage markets. So until the next video, I'll see you then. Bye.